is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Happy Monday. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, and for Francine, here's what's coming up on today's program. Protests grip China. Demonstrations erupt in cities, including Shanghai and Beijing, in a rare show of defiance against the government's COVID curbs. European markets follow Chinese indices and U.S. futures into the red as the turmoil sends a shiver through global markets. Let's check in on those markets because it really is that one story that is dominating risk appetite, and risk appetite, there is little this morning. It's really the uncertainty of not just the protests, but what it means for COVID restrictions. Could they be more harsh? Now, some of the worst of the selling, we have backed off of that. S&P 500 futures down about 0.5%. Late trading last week, given it was a holiday week, but we did see Asia stocks, specifically Chinese equities, see their worst fall in about a month. Now, alongside equities falling, you did have some buying coming into treasuries, so lower yields plus a lower dollar did mean that at the moment we're seeing the Japanese yen appreciate by more than 1%. It is on track for its biggest monthly appreciation since 1998. So the China demand for a haven story feeding into the peak yield, peak inflation, peak hawkishness narrative. But adding into that disinflationary narrative is NYMEX crude. It has done a round trip. U.S. WTI crude is now at its lowest level since December 2021, wiping out all of the gains for this year. Now, along with that China story, one of the other folds in this has been the lockdown, some of the restrictions around that Foxconn factory, trying to lure in more workers with bigger pay. According to people familiar, the Apple iPhone Pro will see about 6 million iPhone Pros close a shortfall, rather, of production of that specific model. So Apple pre-market just opening down 1.2%. The wider European context, basically every single regional benchmark is down this morning. Taking another leg lower after Klaus Knot of the ECB, a bit of hawkishness coming from him this morning, saying that, look, inflation risk, it's almost entirely to the upside, and they need to get inflation down. They need to get growth down in order to get inflation down. So let me show you what the European map looks like. Basically, everything is down, and it's being led lower by energy, the worst performing sector. Don't have that for you in the moment. We'll bring it to you later. But there you go. TV magic. UK stocks, those are down about 0.7%, one of the worst performing, again, because it is energy and materials that are the worst hit this morning. Let's continue with that story. In China, protests against COVID controls have spread across the region as citizens frustrated by strict rules took to the streets over the weekend. Some protesters in Shanghai even called on President Xi Jinping to step down, a level of dissent unheard of since she took power a decade ago. We're joined now by Luigi Speranza, Global Chief Economist of BNP Paribas Markets 360 division, along with Bloomberg's Greater China Executive Editor John Liu. John, let me start with you. Can you put these protests in the wider historical context and just in the context of the moment?
These protests are pretty unprecedented in the sense that public displays of opposition to government policy is very rare in China. It does happen from time to time. I've been in Beijing for 12 years, and this is the first time I've seen anti-government protests of this scale here in this city. And again, you've had them in Shanghai, you've had them in Chengdu, you've had them in Wuhan and other cities across the country on varying scales. In Beijing, we're talking about a few hundred, maybe upwards of 1,000 people. In Shanghai, several thousands. In other places, much smaller than that. And so it does speak to the frustration, the fatigue that people are going through when it comes to COVID restrictions. And of course, this all being sparked off by that fire in Xinjiang late last week that killed 10 people. The protesters saying that the COVID restrictions, or suspecting the COVID restrictions, delayed firefighters being able to get to that blaze and putting it out.
So John, what are we hearing from the protesters themselves? Yes, it might be in reaction to the fire, but are they calling, for example, for an end to COVID zero? What are we sort of hearing on the ground?
The protesters are calling for an end to COVID zero, for no more tests, for no more restrictions. I think they represent a relatively more extreme slice of the population, obviously. You've seen much more across Beijing, for example, different neighborhoods across the city, neighbors getting together, opposing local government officials trying to lock down their apartment complexes, arguing that it's not a scientific way to try and stop infections. There are a lot more people who are opposed to the strict lockdowns that force people to stay home, the use of chains and bolts to close doors so that they cannot be opened. The fact that they are a safety risk if there were a fire, for instance, that's much more widespread. A little bit more extreme is this call for an end to every sort of restriction when it comes to COVID.
Luigi, let me bring you into the conversation. So that's the color on the ground that John just gave us. What are your concerns when it comes to these protests and the impact of it on Greater China?
Yeah, I think the key issue here is that they are not likely to change the stance of the government when it comes to the COVID-19 policy, at least in the near term. The measures have been just announced only recently. Will take time to assess their implications. So in the short term, it's bad news for the economy. Higher uncertainty, concern the government might go hard in terms of reactions. And protests could also lead to new supply constraints emerging and likely to be associated with weaker consumption. Now, as we move in the future...
Yes, continue, Luigi. What happens as we move into the future?
I think the public outcry supports the view of a continued relaxation in the COVID rules, albeit in a gradual fashion. Will be very much the case of 2 steps forward, 1 step back. But the bottom line, I think, is that the economy is not bottoming out yet. The markets will be concerned in the short term. And we continue to expect a turnaround in the spring next year as measures get gradually relaxed.
John, you know, in reaction to what we've seen in China over the past 2 years to COVID, the measures have really been focused on industry. Have there been any rumblings of potential economic measures for the individual?
There have been some efforts taken at that. There have been tax cuts across the country. There's been some talk among economists that maybe what China should do is something more akin to what's been taking place in some countries in the West, directly handing out money to the individual. We've not seen any serious move in that direction. Again, the government here is quite stretched when it comes to the fiscal budget. All of the testing that's been done, all of the building of the temporary hospitals. And also we have this property crisis that's been unfolding for the last few years, and that's really sapped the revenue coming into the budgets of the local governments and the central government.
Mm. Well, Luigi, you know, we've seen things, for example, like the PBOC reducing reserve requirement ratios for the second time, injecting more liquidity into the economy. John was laying out some of the other measures there as well. But Luigi, what does it really do to help growth in China if, again, the issue at the moment is demand for liquidity, not necessarily liquidity itself, but just the demand side of the picture?
Absolutely. I mean, in these circumstances, you know, policy accommodation is a bit pushing on a string. Effectively, I think the fundamental problem is really the COVID-19 rules. The expectation here is that as they are relaxed, that policy accommodation might have a significant impact at a later stage, which is what we're looking for in 2023, a turning point. But this requires further relaxation in the measures. Until they are in place, I think monetary policy accommodation is not that effective.
But Luigi, I look at sort of maybe a bit of a false dichotomy, but the scale here of either letting the virus spread or imposing tougher restrictions, it does seem neither is particularly good for growth in the short term.
Absolutely. That's the key dilemma the authorities are facing at the moment. I think here the whole point is to increase the level of vaccination in order to allow you know, greater relaxation at the later stage. That's our expectation. But in the short term, is you find yourself between a rock and a hard place.
And just seeing a headline coming through our team flagging that Beijing vowing to curb rapid growth in COVID cases. John, you know, this, of course, comes as we've gotten some sort of measures of more targeted approach, one that helps to allow the economy to grow at the moment. How difficult is that considering growth in COVID cases? Or how much have we seen COVID cases pick up at the moment throughout China?
COVID cases are at a record high here in Beijing and across the country. And partly contributing to that, I mean, obviously, the new Omicron variant is far more transmissible than the earlier variants. It's wintertime as well. But also contributing to that is China was trying to loosen, trying to give more space to the economy. And that's unfortunately, I think, also helped push up the number of infections. The point, though, is that the country is still committed, as we've seen high-level officials repeat many, many times over, to getting infections to zero. And as long as that remains the ultimate goal, I think, unfortunately, they're going to have to resort to testing, to lockdowns, to these sorts of things to get there.
Luigi, what do you make, given that we have Goldman Sachs, for example, seeing a 30% chance that China reopens before the second quarter of 2023? Would you pin the odds at something similar?
Our long-term view has been that the process would be very gradual, but by spring next year we can see significant changes cumulatively that would allow the economy to turn the corner.
Okay, and what exactly would that look like? What sort of pace, what sort of timeline are you expecting?
I think the spring, weather also, better weather, helps there. So we look at the spring as at the turning point. Again, a gradual process, but with more effective implications after the spring, with a turnaround in the economy, which would mean still super growth for a very long period, and certainly a kind of a negative outlook in the short term, as you were mentioning.
Yeah, and again, sort of these two opposing forces that China needs to weigh. I mentioned that line about them curbing rapid growth in COVID cases. Another line coming from an official that Beijing vows to reduce the impact of COVID on the economy to a minimum. So certainly a nuanced picture. John, thank you so much for joining us. John Liu, our executive editor for Greater China in Beijing. Luigi Speranza, chief global economist of BNP Paribas Market 360 division. Thank you so much for joining us. Now, coming up, oil in focus as WTI drops to its lowest level since December. We're going to have more of that next. This is Bloomberg.
As long as we're seeing the ongoing COVID zero policy, we're not going to see much of a stabilization in domestic demand unless the government really moves away from its targeted approach.
At this point, it looks like that a rapid or a reckless opening of the economy will be worse for China's growth, because the biggest problem now, of course, is in the labor market.
For the time being, it seems that the outperformance that we have seen in the Greater China region could be capped in the very near term.
The next few months are clearly going to be challenging, but we still feel comfortable that in the second half, China is going to be a much better story from an investment perspective.
Interestingly, the mall is doing well, primarily because people can't travel. So we're seeing good spending and good foot traffic in the mall.
Some of our guests weighing in on the China protests, which have caused a risk-off mood in markets, especially oil. It tumbled to its lowest level since December, so it has made a round trip, this unrest in China. For more on this, let's get to Bloomberg's Will Kennedy, senior executive editor for energy and commodities. Will, I mean, why has this rattled energy markets so much, this oil market? I mean, does this change the reopening narrative so much that we need to send WTI lower by 2.5%?
Clearly, it's a risk-off event for the oil market. Oil market has been extremely worried by the state of demand in China, that this adherence to COVID zero is keeping demand suppressed, that people aren't moving around China as much, they're not driving, they're not flying. And that comes against a background of what seems to be ample supply. For all the talk of price cap and sanctions, Russian oil keeps meeting the market, keeps getting out of Russia. Russian oil production is near the highest since the war started. So you put that together the supply from Russia with concerns about demand in China, and you get a slightly nervous, slightly weak market.
Well, to that point, OPEC Plus meeting is taking place this coming weekend. What do these declines, what does the China story mean for them?
Well, I think most people had expected a rollover. Obviously, OPEC Plus have made a big cut at its last meeting, and it probably feels vindicated in that decision, given how soft the market has been since. But we should perhaps be looking at the possibility of a cut too. I don't think any decisions have been made yet. But if you think back until when the Saudis put out a statement last week denying speculation of a production increase, they clearly gave themselves room, and they said that they wouldn't be afraid to cut. So when you see a weak market like we've seen today, when you see prices nudging 80 on Brent, I think the market has to think that a cut is possibly part of the equation going into this weekend's meeting.
Now, well, you mentioned in your first answer oil price caps on Russian oil. Now, on Friday, we were supposed to get a decision by the EU, but it seems like no consensus has been reached, and they're going to restart these talks on Monday. Does it seem like this is something the EU is going to be able to be united on, or are there just too many divisions between the nations?
I think the expectation is that they will get to some form of agreement in the end. Clearly, what's going on is that those countries in Eastern Europe which want to come down hard on Russia want the cap set at a meaningful level which will curb Russia's oil income. I think other members want the cap set at a price which would allow oil to keep flowing at today's prices. They're finding it hard to reach a consensus. I don't think they'll want to let the whole thing fall apart. It does seem that they'll get to a place which won't have a material impact on the flows of oil outside Russia, and I think that's what really matters to the market right now.
Okay, Will, thank you very much. Bloomberg's Will Kennedy there. Now, I want to switch gears to the ECB, where Klaus Knot, the ECB policy member, has been speaking in Paris, saying it is a, quote, bit of a joke to talk about over-tightening now. So we're looking at the euro on the highs for the morning. It is up 0.5% at its strongest versus the dollar since June 30th. Earlier this morning, he was also saying that the outlook for prices are still skewed to the upside despite the region facing a recession. Now, coming up, we're going to get back to the China story. Street protests in Shanghai and Beijing take place as Chinese citizens run out of patience with strict COVID curbs. We'll bring you updates throughout the show. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I am Danny Berger in London. Let's now get to your first word news. With that is Alice Adkins. Alice.
Thanks, Danny. European Union diplomats are expected to resume talks later today on capping Russian oil prices. Poland and the Baltic states are unhappy at a proposal they consider too generous to Moscow. A senior diplomat says Poland wants additional sanctions as well as a review mechanism and a price below the market level. Taiwan's ruling Democratic Progressive Party has suffered its worst ever showing in local elections, with the opposition gaining power in the capital, Taipei. Taiwan's president quit as DPP party leader after the losses, which came amid rising disquiet over cost of living issues and an uptick in COVID deaths. Profits at industrial firms in China continue to decline in the first 10 months of the year, weighed down by COVID restrictions and falling factory gate prices. Industrial profits in the January to October period fell 3% from a year earlier. That's after producer prices contracted last month for the first time in almost 2 years. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny.
Laura, thank you very much. Laura Wright in London, not Alice. Laura, I love you. I promise I know what your name is. All right, let's get a check-in on these markets. And really, we started on the back foot with these risk markets, considering the concern over protests in China, what it means for policy, what it means for COVID lockdowns and China demand. European stocks continue to fall, being led lower by the energy sector, energy faring the worst out of any of those sector groups, given that we're seeing WTI crude fall nearly 3% at the moment. It has now made a round trip. We're looking at all of the gains in oil for this year being wiped out. Again, that China demand adding to it. We're talking to Will Kennedy about that earlier. You also have an OPEC Plus decision coming up this weekend. How does that factor in? Euro, that is moving higher, up 0.5%. That's being driven by some hawkish language we have coming from Klaus Knot, saying that the main concern is declaring victory on inflation too early, also calling it a bit of a joke to talk about over-tightening now, and that the risk to inflation forecast is entirely tilted to the upside. That is certainly some hawkish language. It also does mean that you're looking at a weaker dollar this morning. It started on the front foot. Really, the haven bid in the currency space has been to the end. If you look at the GMM screen, that is on the top of the Forex column there. That's the second column. Meanwhile, all those commodity currencies, they are being hurt by that lower oil, be it Canadian dollar or Aussie dollar, also a bid to U.S. Treasuries. Now, coming up, was Black Friday a success for the retail sector? We talk with eBay UK General Manager Murray Lamble next. This is Bloomberg. Protests grip China. Demonstrations erupt in cities including Shanghai and Beijing in a rare show of defiance against the government's COVID curbs. European markets follow Chinese indices and U.S. futures into the red as the turmoil sends a shiver through global markets. Plus, commodities also hit. Iron ore and oil slide amid concern over the strength of the Chinese economy, with WTI dropping to the lowest level since last December. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's talk retail. And eBay UK says the Black Friday shopping event no longer delivers on its promises as people struggle with the cost of living. And to help address the problem of post-consumer waste, the e-commerce company says it only promoted refurbished and second-hand deals this year. We're joined now by eBay's UK General Manager, Murray Lamble. Murray, thanks so much for joining this morning. So how was Black Friday? Did the sales go off as expected? How did they compare to historical levels on eBay?
So what we saw in our UK business was just a booming sale in pre-loved, refurbished and used inventory. And that was because, one, customers were getting genuine bargains, and two, there was a definite shift in environmental concerns. We've seen that growing for the last few years, but it was more acute than ever this year. So that was our real high spot of the Black Friday sales, and will continue, I think, over this next few days as well.
Well, I know when you and the folks at eBay announced this push for reused goods, part of what you had said in this press release is that Black Friday is broken. Was this Black Friday also broken?
What's broken is that customers have got increasing concern of, am I getting a genuine deal or am I getting a genuine bargain? There's been tons of coverage of that over the last few years. And secondly, this growth in concern about the environment, it kind of went on pause during the COVID period, but has come back very strongly. And so over half of consumers that we spoke to were genuinely going after looking for used refurbished items this peak season for both of those concerns. Am I getting a real deal? And am I going to reduce the impact that I have on the environment? And so it's kind of playing out as I think it needs to. It's helping the retail industry shift to think about more about circularity rather than just production through to consumption and just that linear process. It's how do you think about products in a much more circular way? That plays to what consumers need, and there are so many great products out there when they're refurbished or used that customers can get. It's going to be a shift, I think, in the next few years in how the retail sector will operate.
Are you concerned, though, because typically in a crisis, in inflation, when consumer wallets are pinched, a lot of times sort of the ESG story gets thrown out the window. It means, you know, folks looking for clothes go to fast fashion or go to the cheaper models that aren't necessarily environmentally friendly. Are you concerned that that shift will start to take place as inflation really starts to bite?
It's interesting. I've heard the argument a few times to say that you can't be environmentally friendly and have genuine value for consumers. And I find that a bit disappointing in that there's so much more out there. If businesses, our platform, our businesses to help the retail sector showcase the brilliant in used and refurbished products. We've done things like classify our refurbished products when sellers sell so that buyers have confidence in what they're buying. We put guarantees around our products with things like authenticity guarantee, and therefore consumers can buy with confidence. And actually you are getting a genuinely lower price than you are on new items. And so actually this play of, yes, there's a cost of living crisis. Yes, I'm looking to save money and I can have an environmental impact can work in unison, and they don't need to be disconnected from one another, as is typically the argument. And we know that if you're buying a used or refurbished product, that the environmental impact is exponentially lower because you're increasing the length of time that product is in use.
What do you make of the UK consumer and the strength of the consumer right now?
I think that the UK consumer continues to surprise me. I think what we're seeing is a big push still in fairly high-end sales, so people buying more expensive items, so they're collector's items, whether they're buying sneakers or whether they're buying more high-end watches. And then I see a big play into I don't see necessarily this clear trading down, but looking for genuine alternatives to value. So rather than the latest iPhone release, get me the previous season or the previous season to that one, or get me an open box item because I know that that is going to be a genuine bargain for me. So a more thoughtful consumption than we've seen in the past, and that value for money just popping up on priority lists.
Is that the sort of K-shaped recovery, though, of on one hand you have people who are still willing to pay probably what is an absurd amount in my mind for a pair of sneakers versus, however cool they are, versus someone who's looking to kind of make sure they get that bargain?
I think that consumers are able to choose a diverse range of options depending on their need state, rather than customers being in Block A or Block B as could be articulated. We've got one of the most advanced online retailing economies in the UK. It's an amazing part of our retailing sector. As I say, one of the most advanced in the world, and therefore customers are able to have a selection and say they want to spoil themselves here or treat themselves here, or they just want to get genuine value rather than feeling the need to always pay full price for all items.
So the demand is clearly there, but what about actually getting the products to consumers? How much of an issue has strikes from the Royal Mail, for example, been in being able to actually deliver?
To repeat the point about having the most advanced retailing economy, having a good postal infrastructure is essential to that. And that works in unison with the amazing online retail sector that we've got. And so our encouragement is clearly for the Union and for the Royal Mail to reach a conclusion as soon as possible, because it is detrimental to the overall health of our online retailing sector, that's for sure. I've also been encouraged by how private enterprise, other private enterprise has stepped into the fold and is helping to think about a growing capacity. Our job is to give alternatives for the businesses that use our platform and ensure that customers can get what they need and expect, and we'll manage expectations on both sides, but we do encourage the fastest resolution possible as it is disruptive.
If it doesn't get resolved, what does it mean for the holiday season then?
I think that customers are savvy and aware, and therefore they're more advanced in terms of their retail online shopping just because of the familiarity with it a few years on. Our job is to make sure that customers are fully aware of when to expect their item and then how it arrives, and I think most other retailers will be in that same position as well. And so I'm not expecting a big set of surprises, and as I said, pleasantly surprised by the way that other partners are stepping in to be able to mitigate those activities.
So what you're saying is I should have started my holiday shopping already.
Worth considering.
Okay, good to know. It is interesting, you know, speaking with friends of mine, all of a sudden all the options that exist out there to sell secondhand clothes and items. I won't buzz market them, but there does feel to be a lot. What has that competition meant for you?
Competition is a wonderful thing in terms of how it helps you up your game. We are the second largest retailing site in the UK. We have over 20 million customers that visit our site every month. They clearly find a great deal of value in their ability to sell and buy and transact on the platform. And when you combine that with the small business dynamic, we have hundreds of thousands of small businesses that use our platform to trade alongside consumers selling. It brings a richness of demand from customers who visit to buy. So all of those things work really nicely in terms of a network effect, and that's the beauty of the marketplace, and that's why the business continues to thrive here in the UK.
Do you expect consolidation in this space as these new players pop up?
I think that it's a very innovative space, and there's a ton of runway still to go. So still less than a third of sales in the UK for retail are online. There's a long way to go to evolve, and I'm expecting more advancement in terms of services and solutions. I've mentioned things like authenticity guarantee and our refurbished program, and those are really nice ways that we're helping to meet consumers' demands as they advance and get more specific in the types of products they're buying.
All right, Murray, thank you so much for joining us. Murray Lambell there, General Manager of eBay UK, after what was a busy Black Friday. Now, I want to bring you some lines coming from Barclays. Venkat, the CEO there, will undergo treatment for non-Hodgkin's lymphoma, according to the company statement, he said in the letter that the doctors have advised that my prognosis is excellent and my condition is curable with their prescribed regime. This is likely to last 12 to 16 weeks. The CEO also saying that the company will run normally, will still manage it. Again, this is the CEO of Venkat saying that the company will run normally and saying, I will continue to be actively engaged in managing it. Now let's turn to a different UK story, and Rishi Sunak is set to deliver his first major foreign policy speech as UK Prime Minister later today. He's expected to say the country should plan its foreign policy for the long term to match the strategies of other world powers such as Russia and China. Joining us now for more is Bloomberg's UK government reporter Emily Ashton. So Emily, set the scene for us. What are we expecting from Rishi's speech?
Well, it's interesting tonight because this is Rishi Sunak, the Prime Minister's first foreign policy speech. He's mainly known for his Treasury, a former Chancellor. So it'll be very interesting, lots of people watching. And he will talk about dealing with China and Russia with robust pragmatism. And that might be seen by some critics as maybe a softening approach to China. So a lot of eyes will be watching that. And as I say, this is a very interesting speech in the City of London because he is mainly known for his work with domestic affairs rather than foreign policy. Well, so lots of people.
I was going to say, speaking of domestic affairs, you know, Sunak, perhaps the honeymoon period is over. What's the latest on this wind farm rebellion that he's facing?
That's right. So onshore wind is the latest problem that he has in his inbox. We have about 30 Conservatives who've said they're going to back an amendment from a senior Conservative to the Levelling Up bill. And they want to see more onshore wind built in Britain. Well, Rishi Sunak said when he was running for leadership that he did not want to see any more onshore wind. He has a real problem because Labour want to back that amendment. And so he faces the prospect of the government being defeated. So I think we might see, before that amendment comes into the Commons in the next couple of weeks, some softening of the approach, maybe a concession from the government on onshore wind.
How much does this seem as an indicator for the rest of Rishi Sunak's premiership, given that, you know, when he took over as PM, there was some expectation that perhaps this is a more fractured Conservative Party? Will that continue to play out, and how will it continue to play out?
I think in a way we're seeing kind of politics as normal after a really strange few months. I mean, he came in as Mr. Sensible, trying to clear up the mess of kind of Liz Truss and Kwasi Kwarteng's government. And now he's seeing the reality of what Prime Minister means when you have a pretty fractious Conservative Party, different wings wanting different things, and a Conservative Party that is about 20 points behind in the polls. They want to do everything to get back up there and try and win the next election, and that is going to prove difficult for him.
Okay, Emily, thank you so much. That's our Bloomberg UK government reporter, Emily Ashton. Coming up, Mark Mobius calls $10,000 target for Bitcoin. It's at about $16,000 now as the unrest in China combines with the FTX scandal, creating more confusion in crypto. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get your Bloomberg Business Flash now. With that is Laura Wright. Hi, Laura.
Hi, Danny. China Evergrande Group says it expects to receive restructuring support from offshore creditors by late February. The statement came as Hong Kong's High Court accepted the company's plea to adjourn a winding up case until March the 20th. Evergrande is the world's most indebted developer with more than $270 billion of liabilities. Elon Musk says Twitter is now hiring. The owner of the social media company tweeted a slide from a company talk with the words, "We're recruiting," but without any further details. This is a dramatic restructuring which has seen the firm's headcount slashed by half. Musk says new user signups have been at an all-time high. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg has learned that the unrest is likely to result in a production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. The government of the Bahamas has criticized the person in charge of restructuring crypto exchange FTX. Attorney General Ryan Pinder says statements made in U.S. bankruptcy proceedings by John J. Ray were, quote, regrettable and misrepresented actions taken by his nation's securities watchdog. The comments are the latest salvo in an escalating fight over the FTX collapse. That's the Bloomberg Business Flash. Danny.
Laura, thank you so much. Now let's talk more about that crypto story with cryptocurrencies following global markets lower, feeling that downward pressure of the protests in China. Now, at the same time, as Laura was mentioning, that FTX scandal continues. It weighs on sentiment of digital currencies. For more, Bloomberg's crypto reporter Anna Herrera joins us now. Anna, are you surprised that some of that angst over China is finding its way into this crypto market?
Not really. I guess before the FTX scandal, we were seeing crypto following other assets, and it was quite correlated. So it's not a surprise. But I guess we'll have to see what happens today, now that the U.S. is kind of reopening after the holiday last week. If there's more contagion from FTX, that might impact price more than what's going on in China.
So at the moment, maybe a return to normalcy of how it usually acts. Mark Mobius was also on the program a couple of hours ago saying that Bitcoin could go to $10,000. Are a lot of folks expecting that level of bearishness? I mean, how realistic is that price target?
He's not the first to mention it. And of course, if you look at what's going on in the crypto industry, that's not like a totally outlandish call. And again, obviously, we'll have to see if there's more contagion, then that might be a more realistic price target, right? If there's more company collapses, then, it's surprising that Bitcoin has held up so far so well. I mean, not compared to a year ago, but over the last few months, it's stayed somewhat stable despite the catastrophes that were going on.
Yeah, fair enough. If we're expecting this gigantic ripple effect throughout the entirety of the industry, perhaps Bitcoin would be worse. Speaking of which, where do we stand on FTX, the proceedings themselves and those threats of wider contagion?
So the proceedings are going on in the U.S. We don't know who the creditors are yet. They've been able to keep those private, and they've the names aren't public, and that might be a source of potential, jitteriness, I guess that's the word, going forward, because we'll figure out who might be one of the counterparties. And then obviously in the Bahamas, the regulators there have also been trying to act, and that's created a source of tension between the two, because FTX was based in the Bahamas, and the Bahamas have an interest in saying, you see, it's not our fault that the company collapsed. There were companies everywhere, and so they've tried to act as well.
All right. Anna, thank you so much for joining us this morning. Bloomberg's crypto reporter Anna Herrera there. Now, for more on this ever-evolving digital landscape, listen into Bloomberg Crypto. It's a daily podcast hosted by Stacey Marie Ishmael. You're going to hear from about the biggest stories from the most interesting people transforming the world of crypto. Find us Monday to Friday, wherever you get your podcasts. Coming up, European markets into the red following the drop in Asia equities. Those ripple effects from the protests in China not just being felt in Bitcoin, being felt across the world in risk assets. We'll wrap up the 2 first hours of the Open for you. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, 2 hours into today's trading session, or just less than that, let's get a track of where we're at. It's Bloomberg's Joe Easton joining us on set now. Joe, it really does seem to be that the news out of China, the protest, potential reaction to it is just dominating risk sentiment, even in Europe.
Yeah, exactly. I think it's such a volatile situation to predict. I saw there was a report from Goldman saying that the Chinese economy could reopen in the second quarter of next year. I think that's probably about as reliable as one of my World Cup predictions. But I think that given we did see 2 weeks ago, we saw equity markets and oil move higher when there was news that China could reopen. Although this also came at the time when bond yields were moving lower, earnings were looking pretty strong. So I think there was a few drivers behind it. But now we're seeing some of that coming off today, and I think it's the main reason we're seeing markets lower this morning.
I do wonder if it continues to be the main driver because, you know, we are off the back of, 6 weeks of gains in European indices. Maybe it's not strange to see consolidation. But in terms of the calendar for the rest of this week, what looks like it could be driving sentiment?
Yeah, so we've got some big events coming up. Euro area inflation and inflation from specific countries, including Germany. That's going to be big. And also Powell's speech in Washington, D.C. That's coming ahead of the Fed blackout period, with the Fed's meeting coming up in just over 2 weeks now. So I think the main thing for markets is still inflation, and that will continue to be the main driver. But this China news is adding to that risk-off sentiment, so to speak. And I do think that going forward, maybe after today, I think people will be looking more at the inflation picture.
Yeah, well, I mean, to be fair, we are seeing the euro stronger today with Klaus Knot talking in Paris about this idea that, you know, it doesn't make sense that, you know, we would be talking about a pivot, that inflation is still enemy number one. Now, when it comes to inflation, I'm going to try to do an elegant segue here. House prices have obviously been a big driver, and the hope is that they're coming down with higher rates. We're also joking about in the break how I'm looking to sell, you're looking to buy, and so I'm expecting you to tell me that I'm the one who's in trouble at this moment.
Well, yeah, I think this story is probably a bit better for me than it is for you, because Zoopla today is saying that the agreed prices are falling below asking prices for the first time in 18 months. So it's becoming even more of a buyer's market, really, you know, getting better pricing. And I think that you had a guest on earlier from eBay, which was really interesting, and he was talking about how the UK consumer is actually a little bit stronger. Obviously, he's hoping that is the case. But I do think that we're seeing those signs of actually the UK consumer weakening and therefore trying to cut back and trying to reduce their spending, even on things like houses. And I think that, yeah, as we mentioned, good news for me, maybe not as good news for you.
Well, it's also probably not great news, I mean, for the Marks and Spencers of this world. Last time I checked, they were down pretty significantly. How much does 2023 turn into a bearish story for the UK retailers?
Yeah, I mean, it's got all the hallmarks of being a disastrous year for retailers, really. I mean, I think mortgage payments could reach 50% of people's incomes, which is only slightly below where we were at the global financial crisis. Mortgage payments, utility payments, doesn't leave much money to buy new clothes to go out on the weekend, really. So I think that retail is looking bad, but then the stocks are down a lot. I think Marks and Spencers is down 50% this year, or almost that amount. I'm not sure on the specifics, but a lot of it's priced in, but it's not going to be a good year for earnings, that's for sure.
Okay, Joe, thank you so much. And yeah, if you're looking to buy a flat, I've definitely got one to sell you. Mates rates, I promise.
I'll give you a buzz. Yeah.
Perfect. Bloomberg's Joe Easton there. All right, as we wrap up the hour, let's take a look at where we are on these markets. And as Joe mentioned, we do continue to see selling in this European equity market, following through on that negative Asia session, where Asian equities, specifically China, saw their biggest monthly decline in about a month. We're down nearly 1% with the Euro Stock 600. Energy, the worst of the decliners. You can see NYMEX crude now down more than 3%. It is the demand side of this equation that we are fearful of if there are more lockdowns, if it does get more stringent off the back of these protests and rising cases. Now, there is a bid into the 10-year yield. You can see there at 3.65%, or just nearly 6.6. You know, we are looking at a 10-year yield that is below the Fed target at this moment. It's this recession trade that's starting to come into the fold, and we are looking at a stronger euro with Knot, as I was just talking to Joe about, very hawkish, saying that inflation, the risks are still one way, it is to the upside. Well, Bloomberg Surveillance Early Edition will continue in the next hour. Matt Miller and Kailey Leinz are in New York. Anna Edwards out of London. This is Bloomberg.
right now, I think hoping for a change in attitude on the part of the central government is not in the cards. People are very, very frustrated, and they're willing to give up everything in order to get out of this situation.
As long as we're seeing the ongoing COVID zero policy, we're not going to see much of a stabilization in domestic demand.
The next few months are clearly going to be challenging, but we still feel comfortable that in the second half, China is going to be a much better story from an investment perspective.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Protests spread in China. Citizens frustrated by COVID restrictions take to the streets over the weekend to vent their anger about the government. The upheaval hits Apple. Turmoil at its big Chinese manufacturing hub may lead to a production shortfall of 6 million of the most popular iPhones. And the Chinese unrest adds to stresses in an already fragile oil market. Crude falls to its lowest level in almost a year. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, clearly the Asian equity session, Asian markets generally preoccupied by what we're seeing over in China and to some degree for global assets as well. And we're all focused on whether we see a return to that protest activity and how Chinese authorities will respond.
Yeah, and ultimately what it all means for the reopening of the second largest economy in the world, Anna. As you say, this definitely roiled Asian markets overnight. Broadly, it was a risk-off tone with stocks down really across the board. The MSCI Asia Pacific Index as a whole down by about 0.7%. But it was Chinese equities in particular that really underperformed. The Hang Seng China Enterprise Index down about 1.7%. And you're seeing the ripple into foreign exchange as well. The Chinese yuan, the onshore yuan weakening against the US dollar to the 719 level. But it is actually the South Korean won, which of course is very sensitive to the trade story with China, that is underperforming in Asian FX, weaker against the dollar by 1.25% to around 13.40. And finally, in the bond market, you are seeing a bit of a haven bid coming into government bonds really across the world, with yields moving lower. And that was true in both Australia and New Zealand. The New Zealand 10-year overnight falling about 9 basis points to 4.02%, Matt.
All right, well, we are looking at futures here that are down about 1% after doing a whole lot of nothing on Friday, really unchanged at about 4,026 in the cash trade, but we're down today on those China concerns. We're also seeing the 10-year yield come down as investors buy the bonds, so now down to 366 on the 10-year yield, which feels relatively low compared to the highs that we hit a couple of months ago. NYMEX crude is off 3.2%. You can see 73.83 a barrel. That's the lowest level that we've seen since early January of this year. So taking it down to levels that consumers may not be used to. The concern, of course, is that there won't be enough gas demand in China to hold the price up. Bitcoin also coming down, although still holding just above $16,187. So it hasn't crashed below that level, but we're going to hear from, for example, Mark Mobius later, who thinks it's headed towards $10,000 a coin. Anna, what do you see in Europe?
Yeah, Europe dominated by the China theme. Then, Matt, we've got European equity markets very much weaker today. Certainly that's the case for the French and the German markets, both of those down by just over 1%. The London market also down by 0.7%. Either it's an energy story, it's an industrial story, it's a luxury goods story. There are many areas in which, many industries which have links, of course, back to China from Europe. This is Brent crude then. Matt was just talking about WTI. Brent down by 3.4%. And even before we were talking about protest activity in China, it was going to be a complex story for oil to do with just how fast the Chinese economy was going to have to open up. We have an OPEC meeting coming up at the end of this week, OPEC Plus meeting. What will they decide to do on production? Has the chance of a cut in production just increased as a result of this drop we're seeing in oil prices right now? And this is how energy stocks are responding. We're down by just over 2% on energy stocks. That clearly weighing on the London market today. This weighs on Paris. LVMH is the example of a luxury player that I picked out, but I could have chosen others. Down by 1.3%. So the percentage not huge, but it is a really heavy weight on the Paris index, and so that weighs on the Paris market. And the euro is up by 0.5%. And I put this in, Matt, just to underline, yes, we're risk off in many senses, but actually the dollar is under pressure today. Earlier on, it was actually gaining as a haven trade, but now we see the yen as a haven trade, perhaps even the euro. Our colleague Ven Ram talking about how the pound might be catching some haven bids because money coming out of some of the commodity-related currencies, such as the Aussie and anything to do with the Chinese market like the Kiwi. So that's what's going on in FX. Some slightly pretty interesting moves going on here.
The euro as a haven trade. Very interesting.
It's a question.
Indeed. Yeah, big question mark after that one. Let's get back to the top story now out of China. Protests against COVID controls have spread across China, with some in Shanghai calling on Xi Jinping to step down. Veteran EM investor Mark Mobius spoke to us about the unrest.
It's clear to me that Xi cannot tolerate any protests. So there will be a very tough crackdown on any protesters. More people will be arrested, and they will probably go further in terms of control.
Enda Curran, Bloomberg's chief Asia economics correspondent, joins us now from Hong Kong. So, Enda, how significant are these protests really?
They are quite unprecedented, at least in modern times, for China. Matt, these protests are popping up in cities right around the country. Obviously, the scale differs, but it does speak to the level of frustration that is building among people on the ground now towards restrictions that go with COVID zero. And that's why there's a big question mark now over how the government will or will not respond. You've seen the images on social media. Our own colleagues have been vetting those images to report on them. They are quite extraordinary given the level of political control on political expression in China. So a lot of people have been taken aback by this, and they are asking a big question now in terms of not necessarily what it means for the government. They remain firmly in control, but what it does mean for COVID zero, and will there be some kind of a pivot, or how will the government respond?
Well, and on that government response, and is there any likelihood that there's a real threat to Xi Jinping at this point? Because we did hear some calls for him to be out of power.
Those are very unusual calls, obviously, not just for China, but as we have experienced here in Hong Kong, Danny. I think most experts are saying it's not at that stage yet. The protests aren't at that scale that it would threaten the government per se. But nonetheless, there's a lot of scrutiny now on how the government will respond. They will obviously continue to censor the media, the social media side of things. They've been allowing these protesters to vent to some extent, but will they now respond with maybe harsher police tactics, or will they crack down and arrest some of the ringleaders and the like? And going forward, do they then try and perhaps pivot to meet some of these COVID demands to try and ease the pressure on the people? Because China is trying to navigate a very difficult story here. On the one hand, they're saying, look, we have to keep the virus under control to avoid a public health disaster. On the other hand, they're saying people need to be allowed to live as normally as they can, minimise the restrictions. And that's the big dilemma that's led China to where it is today.
Yeah, and some of our reporting over the weekend really fascinating in the extent, the lengths that people are going to try and protest online in China and to try and keep those protests up as long as possible to try and evade the AI. Thank you very much, Enda Curran, for joining us. Bloomberg's Enda Curran with the latest on those protests. Now, sticking with China, anti-lockdown clashes at Apple's largest factory could lead to a major deficit in the most in-demand phones. A Bloomberg exclusive report sets the shortfall at close to 6 million iPhone Pro units this year. Bloomberg's Tom McKenzie joins us now with some of the details. And Tom, we all remember the pictures. You know, before we were talking about protest activity more broadly. Last week, we were talking about protests at a Foxconn factory in China. And that's what this goes back to. How much of a challenge is all of this then for Apple?
Yeah, and it's a reminder that a company that is so good at managing its supply chain, so sophisticated, is challenged after 3 years of having to put up with COVID restrictions in some form in China. Of course, its most important production area and a major market is really being challenged. So what we're hearing is they're having to reduce output by about 6 million units. You talked about the iPhone Pro. It's the iPhone 14 Pro, absolutely, and the Max. So it's the most sophisticated, most in-demand smartphones for Apple that are being produced out of this facility in Foxconn, and so in Zhengzhou, and so they are being now constrained. There's a lot of uncertainty in terms of whether they'll be able to ramp that production up. We're hearing that they hope to be able to do that in 2023. Of course, the timing's terrible ahead of the Christmas and holiday season. And it's going to come down to what happens with those COVID restrictions. And yeah, as Anna was saying, Matt, you know, you saw this outflow of workers in October. Then they tried to bring them back in with bonuses, and then there were those violent protests.
Yeah, big bonuses. And of course, Apple wants to diversify its production at the same time, right? So does this push them towards that in a faster way? What does it mean?
Well, the analysts that Bloomberg has been speaking to suggest that that is the case. It's going to be a catalyst to move them in that direction. The reality is, and we've talked about this, that given how sophisticated and how entrenched those supply chains are in China, it is actually quite difficult to move because of the complexity and the sheer number of components that go into these phones to just lift it and move it to somewhere like Vietnam. But clearly, Apple have been attempting to do that, countries like India as well. And this, you would have thought, is going to play heavily on the minds of the board at Apple in terms of how they step that up in the months ahead.
Produced in China, designed in California. Certainly the message coming across from some of the graphics we were showing there. Tom, thanks very much. Bloomberg's Tom McKenzie joining us with the latest on that particular dimension of the China story. It is having further impact on broader markets. The unrest in China has also affected oil, which tumbled to the lowest level since December. WTI sank below $74 a barrel following 3 weeks of losses. For more, we're joined now by Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Will, why is the oil market so rattled by the events that we've seen taking place in China over the weekend?
Because I think that it's clearly a risk-off event for many investors, that they're worried about what it means for the trajectory of COVID-0 in China and the outlook for the Chinese economy, which is the main driver of oil demand globally. And it comes at a time where the market already appears well supplied. Russia production and exports is continuing pretty much unfettered, albeit that oil is travelling almost all to Asia now. But production is near the highest since the start of the war. And there's more oil from a few other places in the world, like Kazakhstan. So it's all happening at a background of ample supply and uncertainty about demand, and that's turning out to be a fairly bearish brew.
Well, if we're talking about a bearish brew, what does that mean for OPEC Plus as they gear up to have their next meeting taking place this coming weekend?
Yes, I would say a few things about that. First, I think that OPEC Plus will feel fully vindicated in the production cut that it controversially made at its last meeting. If you remember, many places, including Washington, were very critical of that decision. But given the price we've seen since, with oil back down at its lowest in almost a year, I think Saudi Arabia, the OPEC leader, and its allies will think it was a correct decision. The decision they face now is whether to roll over production, which I think remains the base case scenario for most OPEC watchers, or whether they need to cut further. If you remember last week that the Saudis put out a statement saying that they would consider cutting. And I think that that's going to be the discussion over the next week. How weak does the market look? Does it require a further cut, or do they continue with their current policy?
Well, and Will, very timely, a headline just crossing the Bloomberg terminal, JP Morgan saying that OPEC Plus will need to cut 400,000 barrels per day next year to balance the market, cutting their 2023 Brent forecast by $8 to $90 a barrel. So Bloomberg's Will Kennedy, thank you so much for that timely reporting. Now, we also want to mention that it is Black Monday here in the U.S. Coming off of the start of the holiday shopping season, we saw modest growth for retailers over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts this year lured shoppers seeking a break from inflation. Of course, those retailers trying their best to work down bloated inventories this holiday season. As for how all of these dynamics are translating into action in pre-market trading for some of those retailers, Amazon is down about 1% and Macy's down about 0.9%. So declines that are just a little bit beyond what we are seeing in the broader market. But of course, what is leading the declines in the broader market is the energy sector, what we were just discussing with Will Kennedy, with oil prices under pressure. So the likes of Marathon, Exxon, Devon, Occidental Petroleum, all down in the ballpark of around 2.5% to 3% in early hours this morning. And interestingly, two stocks that are sensitive to the China story are actually outperforming. That would be Wynn Resorts and Las Vegas Sands, casino operators that have heavy revenue exposure to Macau. The reason why these guys are up on a day when most Chinese exposed stocks are down is because of a license renewal for 10-year period that will benefit existing players like these two. So as a result, Wynn Resorts up about 6.6% and Las Vegas Sands higher by about 3.5% before the bell, Anna.
Coming up then, Kailey, we'll get back to the China story. More on the unrest in China with Dr. Yu, Chatham House Senior Research Fellow on China. How significant have the protests over the weekend been, and what kind of response can we anticipate from Chinese authorities? And on the markets, Joost van Leenders joins us. Van Lanschot Kempen, Senior Investment Strategist. How is he rethinking China risks and the reopening timescale around China as we see what has been developing over the weekend? Plus, we won't forget about crypto. The latest on the FT FTX saga with Daniel Seifert, Coinbase Vice President and Managing Director for EMEA. They're actually expanding at the moment. Any second thoughts on that post-FTX? We will talk to Daniel shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. We want to focus in now on China as protests against COVID restrictions are spreading. Citizens took to the streets and university campuses, venting their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai, where some, or at least one, let's say, called on President Xi Jinping to step down. That's a level of dissent unheard of since Xi took power a decade ago. Dr. Ji, you, Senior Research Fellow on China in the Asia Pacific program at Chatham House, joins us now. Dr. Yu, thanks so much for your time. How do you see these protests in terms of, how substantial they are? Are they really unprecedented?
Well, obviously, it's quite significant as China have not seen that sense of joint forces across different parts of the country and different social classes and somehow go against this zero COVID strategy on the one hand. But I think on the other hand, considering the number are extremely small, and also they are basically asking the government to withdraw zero COVID policy, but it's not exactly anti-party and anti-government as such. So I think let's distinguish this. This is not really the so-called 1989 moment again. I don't think so. Even though I do know that people would prefer to making historical preference and relevance for this, but unfortunately, it is not.
Okay, so you don't see parallels with 1989. Does it have an impact on policy, though, Dr. Yu? I mean, I spoke to a guest from Citi earlier on who said there'd be no change in COVID policy as a result of these protests because that would result in a loss of face for the government. Is that a line of argument that you share?
No, I don't. I think the changes has already happened back to 11th of November, and obviously, there's differences in terms of implementation from the central government to local government, but local government double down the measures. So that's one thing make the central government very frustrated. Then on the other hand, I think also we're going to gradually to see the change in rhetoric and change in languages in terms of the policy from the central government, from Beijing. So I think, yes, the way forward, it is to loosening the measures, but the matter is how, and when the government will find the right step to losing that measures.
And will it be possible, Doctor, to loosen the COVID policies at a rate that the Chinese population finds acceptable, and define that however you like, but with infection rates set to go even higher than they are now and deaths no doubt to follow, how will that be explained to the Chinese population that have been told that the Chinese way of managing this is far superior to Western methods?
I think that's the difficulties, whereas the public wasn't really have the sufficient awareness regarding what kind of virus Omicron it is. So I think that's probably one of the biggest hindrance that prevent the Chinese government to reopen the society. So for what governments have to do right now, it is to have a very clear communication with the population, firstly, and what percentage of vaccination coverage that society can open, firstly, and secondly, and what percentage of SU bed availability that society can be open. Until these two messages come across very clear to the population, I think it was still in a very confusing stage.
Well, and I wonder as well how the difficulties around exiting COVID-0 translate into other questionable issues in Chinese policy. One of our Bloomberg opinion columnists, Clara Ferreira Marquez, wrote in a column out today that Beijing's ability to reset public health policies is also a crucial indication of how an increasingly tightly controlled and centralized system will unpick other tangles, be they social, economic, environmental, or geopolitical, that require the same kind of pragmatism. How do you see this translating into other areas of policy, Dr. Yu?
Well, the difficulties in here, it is how to balance the public health and economics like any other country facing in the exit procedure. So for China's case, is how are you going to guarantee those who will not be employed by the state sector a proper insufficient amount of money available to be dispensed in household. And so far, we have not seen that guarantee from the Chinese government at the central level. So I think that is the difficulties, whereas how are you going to balance the economic interest of the billions than, on the other hand, the public health issue.
And of course, it's kind of domestic versus the rest of the world. I mean, how is the persistence of COVID zero policy and kind of the hindering of the Chinese economy affecting potentially this country's standing in the international balance?
Well, China looks like the very odd one in this sense. You know, the rest of the world began to reopen or has already opened for quite some time, whereas China is the only one seems to alone to persist on this zero COVID strategy. So that really leaves China and also leave the Chinese population wonder what exactly happened within their own country. So it's no wonder people will have a question. It is no wonder people are angry.
Does China even have the ability to lift zero COVID without millions of deaths? Do they have decent vaccine preparations? Do they have emergency room beds free? Do they have enough ventilators? Are they prepared for lifting COVID zero?
Well, I'm not a public health expert in here, but I mean, as far as I know, in terms of vaccination to prevent death and serious illnesses, I think the Chinese vaccine is the same as any type of vaccine. As we know that any vaccines, including Pfizer, cannot prevent you from getting infected. So I think what the Chinese government is trying to do right now is try to nudge the elderly population get vaccinated. And so far, I think the government has not really been quite successful. Now, in terms of the SU bed occupancy, I have to say the SU bed availability within China is relatively low compared with the rest of the world, and especially compared with peer-and-peer comparison for many of the emerging market and middle-income country. So I think that's another hindrance for the Chinese society to be fully reopened.
And back to the focus on the protest activity that we see preoccupying news right now, Dr. Yu. If we do see a return to protest activity tonight, for example, or in the days ahead, would you expect it to be met with a violent response?
I don't want to make any predictions in here, as we don't know exactly what has happened. I mean, I'm not within the country. But I think, on the other hand, if people do have the anger, the best the government should do is really to letting people vent those anger.
All right, Dr. Joost of Chatham House, thank you so much for joining us. Really appreciate your time and insight today. Now let's keep you up to date with news from around the world outside of China with the first word. Republicans say they'll demand greater oversight of U.S. military aid to Ukraine when they take over the House. Representative Michael McCaul told ABC News there will be more transparency and accountability. McCaul also said he supports sending Ukraine long-range weapons to defend against Russia. The CEO of Barclays will be undergoing treatment for non-Hodgkin lymphoma. CS Venkatakrishnan says that doctors have told him his condition is curable, and he expects treatment to last 12 to 16 weeks. Venkat plans to continue running the bank during that time. In the UK, Prime Minister Rishi Sunak is facing pushback from his own Conservative Party over a ban on new onshore wind farms. More than 20 Conservatives are backing a pro-wind energy amendment. Soaring energy bills have prompted a number of them, including Prime Minister Boris Johnson, to drop their opposition to wind farms. And after cutting thousands of jobs, Twitter is now hiring. That's according to slides from a company talk tweeted by owner Elon Musk. The first slide has the words, "We're recruiting," with no further details. The slides also said that new user signups are at an all-time high, averaging over 2 million a day in the second week of November. So yet another turn and twist, Matt, in this Twitter saga as Elon Musk has taken the helm. First, he lays off half the company. Then he makes demands of workers that lead some of them to take essentially just packages to exit the company. And now he wants to bring more people back in.
Yeah, and apparently they're signing people up at a record rate. I don't know really what to believe here. I would have thought a lot of people had quit Twitter as well, but I'm not sure about the data there. And of course, since it's not a public company, it doesn't really matter that much, but we love talking about it, Anna.
We love to, well, journalists certainly love talking about it, and the longer you spend on Twitter, the more you think maybe it is just journalists talking to each other. But I'm sure many other people enjoy discovering new contacts via that particular social platform. Just a shame you can't, if you want to leave, shame you can't very easily package up your contacts and take them elsewhere. I know others have been writing about that over the weekend. Coming up on the programme, we'll get back to the market moves that we're seeing, reflecting and bouncing off what's going on in China. Joost van Leenders joins us, Van Lanschot Kempen, Senior Investment Strategist. What are the risks surrounding surrounding China and the reopening assumptions we might have made about the Chinese economy that Joost is factoring into his investment outlook. We'll get to that. And the read across into other assets, be they FX or commodities. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Protests spread in China. Citizens frustrated by COVID restrictions take to the streets over the weekend to vent their anger about the government. The upheaval hits Apple. Turmoil at its big Chinese manufacturing hub may lead to a production shortfall of 6 million of the most popular iPhones. And the Chinese unrest adds to stresses in an already fragile oil market. Crude falls to its lowest level in almost a year. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, we see this story go around the world then, weighing on European equity markets, now weighing on US futures as well. Yeah, absolutely. Futures down almost 1% right now. Actually, a little bit less than they were about a half hour ago, but still off. Right now, we're looking at 4,001 on S&P futures. The cash trade on Friday closed at 4,026, just so you can mark your place here. We're also looking at 10-year yields that are coming down. Right now, almost 2 basis points, but it's a pretty substantial drop from what we've seen. Just a month ago, we were up over 420, and now we're at 366 on the 10-year yield. So a lot less competition there, and it is one way you could see it with S&P yields. On the other hand, that is because people are buying treasuries and maybe a little bit worried. They're not buying the U.S. dollar index, which I think is very interesting right now. Crude off about 2 2/3% right now. 74.24 is the price for West Texas Intermediate. So that has come down to levels that we haven't seen really since January of this year. And then Bitcoin right now off 2%, but still at $16,209, still holding above 16,000. Even though there's continued FTX fallout, it doesn't seem like it's enough to drive the price of Bitcoin down. Kailey, what do you see in terms of pre-market movers?
Well, a lot of them come back to that China story. It's affecting things on the macro level and on the micro as well, with the ADRs, for example, of some big Chinese technology companies down in pre-market trading. Baidu by about 0.9%, JD.com by about 1.5%. You also have Apple lower. Anna mentioned this story. They could face a production shortfall of iPhone 14 Pros by as much as 6 million units due to the disruptions at facilities in China. So Apple is down about 1.8%. And then with the declines in oil Matt was mentioning, you are seeing energy stocks under pressure. The Energy Select Sector Spider ETF, which basically gauges how the sector as a whole will be performing come the opening bell, is down on the day by about 2 percentage points, Anna.
So those are some of the moves that we're seeing in pre-market trading then around the China story, Kailey, on US assets. Well, this is the European verdict on the China story. The European equity market space down by 0.8%, and all sectors are in negative territory here in Europe. Real estate and energy are the worst performers. And here's Brent crude, 81.30, down by 2.8%. Even before we got the protest activity, there was a lot of complexity being built in as we saw COVID rates rise in China. A lot of people asking questions about just how quickly can China realistically reopen. And as a result of that, there have been some downward pressure on oil markets. Add into that, we've got an OPEC Plus meeting at the end of this week. Will we see a cut in production to respond to this weakness? LVMH is down by 0.7% on the Paris market. And this, again, is to do with the China story. So we see this read across from China into some of the luxury goods companies that are listed in Paris. Not a great percentage point move, perhaps, but it is a real heavyweight on the Paris market, and so it takes its toll. The euro is actually up by 0.7%. And this is an interesting one. Perhaps we'll get our guests' perspective on this shortly, Kailey. Up by 0.7%. Through some of the Asian session, we saw the dollar catching a bid. That seems to have changed. Now we've got the yen moving higher, and we have the euro moving substantially higher. I spoke to our colleague Ven Ram on the Markets Live blog earlier, and he was saying that maybe this is to do with interest rate differentials and the slightly more hawkish language we still see from the ECB in the context of the more dovish minutes last week from the Fed. But could all that change when we hear from Jerome Powell a little bit later on this week?
Yeah, Anna, we all definitely will be watching Powell's comments on Wednesday. This morning, though, what we are all watching is the China story and the ripple effects throughout global markets. Joining us now to discuss is Joost van Leenders, Van Lanschot Kempen, Senior Investment Strategist. Joost, how exactly are you looking at the China story and the uncertainty around it?
Well, I think there are two things. You see uncertainty in supply coming back with the restrictions Apple has mentioned. So maybe that restrictions can be so severe that that manufacturing supply will become under strain again. that would add to inflationary pressures in the world. But I think the main impact is on Chinese growth. And we hadn't factored in too much optimism on the lockdowns in our forecasts. So we've seen some measures, some easing measures, which have some have also already been reversed. But we didn't think that a real significant reopening would be feasible before spring, basically. And there had been some optimism, and now it's sort of reversed. We see the number of infections increasing, and the policy, the zero COVID policy hasn't really changed. So that's the demand side for China itself, and then also the ripple effects through the global economy, which have the negative impact now. So
Joost, what are those knock-on effects? What are those knock-on effects that you're seeing in terms of global markets where you are?
Well, energy, definitely. So commodities in general, I think. And so that's basically the demand from China. The luxury goods that were mentioned, maybe some car manufacturings that can be impacted. It's a mixture of supply and demand, I would say.
In terms of safe havens, we haven't seen investors rushing towards the dollar. Indeed, the euro is bid this morning. Is that peak behind us? Do you think the dollar strength has now turned around and we're looking at continued weakness for the dollar?
Yeah, that could be. I think we're close to the peak also with the Fed. The ECB is more tricky in terms of inflation, and the comments that we've seen. They're more, they're a bit more on the hawkish side currently than the Fed is. So I'm not sure if we're in the peak because the Eurozone economy is weakening. So I'm not sure that the Fed will really get to where the markets expect it to be, right? The Fed is expected to hike rates to 3%. If the economy really slows as we expect, then we might see a bit of a lower peak. So I'm not sure if we've really seen that we will see weakness in the dollar, but a further increase, is getting more difficult to because the Fed is also getting to the peak of interest rates.
So, Joost, does the buying of the euro today, does that look a bit overdone then, given what you just said? I mean, we're up by 0.7%, and my colleague suggesting maybe this is, another 75 basis points coming from the ECB soon, whereas the Fed is about to step down. Is that really what's in the driving seat as we try and work through what is impacting FX markets right now?
Yes, that could be. So it's very much so that is very much the short-term expectations. I think within the ECB, it's not a done deal that we get a 75 basis points hike. 50 basis points is also possible. That would also mean that the ECB is slowing a little bit. So this is very much, I think, the moves that we see today is very much about the December meeting. But when you look beyond that meeting, I think it's getting more difficult for the ECB to keep rising rates, especially at a fast pace, than for the Fed, because the Eurozone economy looks weaker to us. We do think that the US will slow down. We see that in leading indicators, but not so much in the real indicators yet.
Okay, and so on that subject of the European economy, Joost, and how quickly it slows down and how you invest around it, I see that you've reduced your underweight in Eurozone government bonds. Is that because you think that will be a good place to spend the recession?
Yes, so we've moved more into bonds. I think a couple of months ago, we reduced our exposure to US equity and bought US bonds. And now, indeed, we still have an underweight in European bonds, which we reduced that underweight because we think, maybe we're already past the peak. I mean, German yields have also, 10-year yields have also fallen to 2.4 to 2.0. So it's also 40 basis points decline. We also reduced our duration exposure. So that's more in line with that we're getting closer to a peak in European yields, yes.
And when it comes to equities, you mentioned kind of pulling back on your exposure to U.S. equities as well. When will it be time to wade back in more meaningfully?
I think when we have clearance about the recession and how deep it's going to be, I think we also need at least a peak in the Fed, and there's been much talk about the pivot. I think the definition has changed a little bit. We see a pivot really as a start of rate cuts, and that's I think too far away for equities to anticipate. And I think also that earnings expectations have to come down. Earnings expectations are positive for the year 23 in the US and in Europe, and I don't think that matches a recession.
Joost, you say that the Fed beginning to cut is too far away for equity investors to anticipate. Does that mean not in 2023? You don't see that?
It may be 2023, but we think it would be quite late in 2023. And then first you'll have the economy slowing. Yes, you'll have inflation coming down, but you also have, I think, earnings coming down. And I think that will be a bigger story for the time being for equities than, I mean, we've seen sort of the enthusiasm about the pivot. Equities up being sort of up 12-13% from the low in October. So that's there, but we think that you will have the earnings story which will be more negative.
Joost, thanks so much for joining us. Good to speak to you. Joost van Leenders of Van Lanschot Kempen. Thanks for bringing us your investment thesis right now. Coming up on the program, we'll get back to the crypto story. Daniel Seifert, Coinbase Vice President and Managing Director for EMEA, comes to talk to us about European expansion. This at a time, of course, when the sector is still reeling from the FTX fallout. More on that shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Shopify President Harley Finkelstein. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, the crypto rout has room to run, according to veteran fund manager Mark Mobius. In an interview with Bloomberg, Mobius said his next target for Bitcoin is $10,000, and he added that he wouldn't invest his own cash. But, quote, crypto is here to stay, as there are several investors who still have faith in it. It's amazing how Bitcoin prices have held up. Which I think we can all agree with. Joining us now, Daniel Seifert, Coinbase Vice President and Managing Director for EMEA. Daniel, what do you think about the underlying asset, the OG asset, right? Bitcoin still at over $16,000, even with all of this FTX negativity. Does it make sense to you?
Thank you, Matt. It's incredible to see the events on the market that we've seen in the past 2 or 3 weeks. Certainly, this has been a major setback for the industry as a whole, the FTX debacle. That said, Coinbase has always sought to be the most responsible, trusted, and secure exchange. And we keep customer funds one-to-one segregated. And therefore, there can't be a situation like with FTX, with Coinbase.
What kind of situation have you seen in terms of outflows? I know a lot of customers are saying, I trust Coinbase that they're holding our assets one-to-one. On the other hand, I would prefer to take my digital assets out and hold them in my own wallet. Are you seeing that?
So we're a publicly US listed company, so I have to be, of course, mindful of what I'm saying here, but we see elevated activity. And when we speak to institutional investors, they are very positive, both live and onboarding institutional investors they have all expressed their faith and trust in Coinbase. And they're probably letting the fallout settle, but they're certainly here to stay for the long term.
Do you eventually see yourself coming out of this whole episode with greater market share, Daniel?
So Coinbase, I think we have taken this approach of seeking to be the most responsible, trusted, and secure platform ever since our founding in 2012. That was at the time a down market. And we've ever since navigated through 4 entire crypto cycles. I think we sort of see ourselves validated in our approach to be the most compliant and most responsible crypto exchange globally.
Well, on the subject of compliance with regulations that still exist, what regulatory clarity do you still need, given you are, as you say, based in the U.S.?
Absolutely. There's certainly more regulatory clarity in the U.S. would be appreciated. As you mentioned earlier this morning, we have made additional appointments of senior leaders in the EMEA region. As we see, the EMEA
It looks as if we've just lost the line to Daniel Seifert, whose time we appreciate greatly because he was coming to us from San Francisco. So perhaps we'll get a chance to re-establish that line. But Matt, interesting to hear him talk there about what this does to the business, or where they see the business being resilient to all of the FTX fallout.
Yeah, and also fascinating that they're pushing to expand into regions that maybe also less regulated or not have kind of regulatory completion amidst this fallout, right? You'd think that you want to wait and see what happens.
Well, I think they're talking about expansion in Europe, aren't they? And saying that actually the regulatory approach is one of the things that draws them to Europe. So that's sort of another dynamic, the complex relationship between where you want to expand and how the regulatory environment really differs. And Kailey, it was interesting over the weekend to see the Bahamas, to see Dubai, places that had really put themselves at the forefront of crypto, questioning whether that was really the right call.
Well, and you saw Bahamian regulators kind of pushing back on some of the claims made in the bankruptcy proceedings around the implosion of FTX. We know that is one of the things that has created a very significant gray area, is the jurisdiction between the Bahamas and in the U.S. as well, given that FTX was an entity based in the Bahamas. So there is a lot of confusion. But coming back to Coinbase, the fact that it is based in the U.S., Matt, maybe feeds back into the idea of it being subjected more to the regulatory oversight of authorities here in the U.S., Anna. But clearly something that players all across the market are still paying a great deal of attention to.
And I think Daniel Seifert is once again with us, so let's get back to him. You were just telling us, Daniel, about your European expansion and the timing of that. Apologies for the line going dead there. You were talking about European expansion. How do you justify that kind of confidence, I suppose, in the industry at a time when many are questioning where it goes from here post-FTX?
Yeah, thank you, Anna. As I said previously, certainly when we talk to institutions, we see the same confidence and the full confidence in Coinbase that we've seen previously, and we do not see anybody leaving the space. And that said, given that EMEA, and when I mean EMEA, I not only mean the European Union with the MiCA regulation, but also the Financial Services and Markets Bill that's passing through the UK Parliament at the moment, as well as the creation of the VARA, the Virtual Asset Regulatory Authority in Dubai, is really leading the charge in creating regulatory clarity and a regulatory framework that we can work within.
Do you think, though, that perhaps tougher regulation might follow, Daniel, in the UK, in Europe, as a result of FTX? Because a lot of people were perhaps disappointed by the lack of transparency in the sector and might be asking questions about what needs to be done about that.
I think you're right. It depends a little bit country by country and market by market. Me being German, you will know about the Kryptoverwahrgesetz that was introduced in 2020 in Germany. So we have already a very comprehensive framework for regulation of crypto assets in Germany. Other markets, we expect them to follow similar approaches.
How far behind is the U.S., Daniel, when we talk about these other countries Anna was alluding to that maybe are a bit more forward in terms of thinking about setting the regulatory landscape for cryptocurrencies?
So what I can comment on is obviously the EMEA region. The United States is certainly looking at creating greater regulatory clarity. In the EMEA region, I can say that I think we have made great headways, and we're looking forward to the introduction of that MiCA regulation soon.
Daniel, thanks so much for your time. Sorry about the technical difficulties. Daniel Seifert there joining us from Coinbase to talk about the expansion the company has planned, plus the fallout, obviously, from the FTX saga. Tune in to Bloomberg Crypto. That's every Tuesday at 1 p.m. New York time, at 6 p.m. in London, for more of our coverage. Our weekly show covers the people, transactions, and technology shaping the world of decentralized finance. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what is ahead this week. It's Cyber Monday today, with retailers offering deals online after Thanksgiving. I know I myself have done a lot of online shopping over the last several days. Then tomorrow, Tuesday, Twitter is set to relaunch the Blue Check service. A lot of drama around that. You can pay instead of just getting outright verified. Then Wednesday kicks off the NATO foreign ministers meeting in Romania. Plus in Washington, Fed Chair Jerome Powell will be addressing the Brookings Institution. Then on Thursday, President Biden will be hosting French President Emmanuel Macron at the White House. And then on Friday, it is Jobs Day here in the U.S. That non-farm payrolls data is expected to show some softening in the labor market. And wage data, of course, also going to be very closely watched, Matt.
Yeah, it's interesting. There's a lot of important economic data and Fed news coming up this week. So while I know over the weekend we have all been reading about these Chinese protests, and of course today that's the focus of the markets, it could look a little bit like a tempest in a teapot come Wednesday when Jerome Powell speaks, right? Because we're going to all shift focus completely, Anna, back to what the Fed does and how the U.S. economy responds.
Yeah, absolutely. So Jerome Powell speaking on Wednesday, and last week a lot of the market talk was dominated by the relative, I emphasize relative, dovishness of the Fed minutes that we saw, Kailey. And then questions coming back about how Jerome Powell is maybe a little more hawkish than some of the other members of the FOMC. And that might be something, a contrast that we're once again talking about today when we get to the middle of the week. Also interesting to see that Powell will be speaking about labor markets, and we will get a lot of labor market data this week.
Yeah, it'll be interesting to see if you are seeing the kind of softening that the Fed is trying to engineer. They would like to see some slack building in the labor market and demand for labor going down as they try to cool the inflationary pressure. So it'll be interesting to see how much progress we are getting on that front as we also beat the drum to the Fed's meeting in just a couple of weeks, Anna.
Yeah, also beating the drum through the World Cup games, of course, continuing in Qatar. And let's hope the action on the field gets a little bit more exciting than it was on Friday. I don't know if either of you watched the USA-England game, but it was fairly boring affair. Apparently very well watched in the United States, for which I apologise. Right, let's get to the end of the programme then. This is it for Early Edition. Surveillance is ahead. They'll be speaking to Morgan Stanley about where assets go from here and about China. This is Bloomberg.